a long phone call yesterday. This is a good client who is trying to track his costs and understand what's going on in his business. He bid the costs exactly what they were. But when he got through entering it in QuickBooks, that 40% margin could become a 20% margin. The fuel in the trucks that the guys drive. If they do 3 jobs a week, job materials, plastic and lumber, and he rents equipment by the month, none of those things sound maybe really huge, but when we added them all up, they were 7%.
Ooh.
Now that will take a 41% margin down to a 33% margin real quickly. That is why we do this stuff. Because you're going along, well, I'm good and everything just fine, but you look at your books, I'm not making any money.
Expert advice, practical tips, real-life stories. Have less stress, more time, and more money in your business. Welcome to the Cashflow Contractor.
Martin, let's jump into it. You got a client, you're working through their books, and something's off. Why don't you set the stage for us?
Well, a long phone call yesterday. This is a good client who is trying to track his costs and understand what's going on in his business and is doing that. But what happened is something I find a lot, and that's people bid appropriately, or they think they are. They take their costs and divide by 0.6 to get a 40% margin. And then they go do the job and they write down the actual hours and the actual material, concrete. And this is a concrete guy. He'll listen to this. The actual rebar and some permits and things that go into that job. And he'll be spot on. In other words, he bid the costs exactly what they were. But when he got through entering it in QuickBooks, that 40% margin could become a 20% margin. Mm-hmm. And we talk about that a lot, you and I, and we have in the past. Is that where management comes in and go, why is that? Yeah. And that's exactly what happened here. It was driving him crazy. He said, why wouldn't it show up the same? And it turns out that there were a lot of expenses that are variable expenses, but they're not easily attributed to one job.
Can you give me an example?
Yeah, the fuel in the trucks that the guys drive, right? If they do 3 jobs a week, right? Are you going to go out there and split the tank 3 ways, if presuming you can make it all week? Job materials, things like plastic and, in this case, plastic and lumber and stakes and things that are used in concrete finishing and forming.
Right.
And
so why would those not be applied to the job?
Well, you're going to go, again, you buy bundles of stakes. Maybe you buy 150 stakes, you know, which sounds like a pretty small one, but they all add up. Another one in this instance was rental equipment. He rents equipment by the month. It's just a way to rent instead of own. And so you say, well, that's a fixed expense. Say, well, no, you could argue that, but I don't. It's a variable expense, but it's not attributed to this job or that job. So
would that be the same? So what would you do though if you owned the equipment and you were paying
I would. It would be an overhead.
So you would put on overhead, but because you're renting it,
because you own it, and it is in fact a bill that you're going to have in perpetuity for as long as you need to own it. So,
but what if it was a lease that you were obliged to pay?
I would have it in overhead.
You'd have it in overhead, but because it's a rental month to month.
Yeah. Okay. Sometimes it's a rental month to month. Sometimes it's not.
Okay.
And you can argue that square or round.
Sure.
Right? That's where I come down. It's a piece of equipment that's needed for the job that is not a standard monthly cost or can easily be not a cost. Mm-hmm. So that's where we put it. So that's where it was located. So that's why that, and there were some other things. Disposal, that could be an overhead if you had or it could be attributed to a job, not as an overhead, but could be attributed to the job if you knew that that load came from this job. That's not what happens. They accumulate full loads before they go take them to where they're disposed. So that doesn't, none of those things sound maybe really huge. Water, things like that the guys drink.
Yeah.
But when we added them all up, they were 7%.
Ooh. Okay.
Now that will take a 41% margin down to a 33% margin real quickly.
Yeah.
Right?
Yeah.
So it's okay. He doesn't have to change things. He doesn't have to. It would drive him crazy to distribute a half load of dirt to this place and a half load to that place, or just to keep track of all that. So go ahead and put it in variable costs. But when he's bidding, he has to have a 7%, that's what we've done, add to his cost.
Quick ad break to tell you a little bit about OpenPhone. If you're a contractor that has a single cell phone, you're probably inundated with text messages and phone calls, oftentimes that you can't be responsive to or that you can't answer at all. So what's the solution? You can buy another office line with Verizon or AT&T, and you can have an iPhone that is passed around from employee to employee, depending on who's on call. But what if there's a better way? What if there's a way that you can have all your phone calls recorded to go back and listen to later, transcribed with summaries so that you can get a quick glance at what happened during the phone call, and even connect it to your CRM where all your other customer information is? OpenPhone is the perfect solution because it does just that. You're able to add all the users you need to for whoever needs to have access to the lines for your company phone. And then you can also find all of the information you need at a glance with a centralized location for all phone calls and text messages with your customers. Whether it's for marketing, for sales, or for service, OpenPhone is the perfect solution for you and your team. If you're interested, we have an offer down the show notes from OpenPhone. Please click the link down the show notes, or you can see it here on your screen to be able to find more information about OpenPhone. Thanks for listening. Back to the episode. So explain to me why this is not burdening.
Burdening is when you take overhead and allocate it across places, right?
Okay.
So you have an insurance policy that costs $20,000. And you say, oh, okay, I'm going to take 10,000 of this and put it with that job. I take 10,000 and put it with this job. Well, first of all, that number is arbitrary,
Right.
right? It could be, why didn't you use 5,000, 6,000? Second of all, you got to pay it whether you do a job or not, and that's the biggest thing. You're going to pay it if you. And the only one of the things I talked about here that you could argue that way is the rental equipment. If you're going to pay a lease every month, and it's never going to change, and you're going to pay it whether or not you have jobs, okay, put it in overhead,
Yeah.
right? But at anyway, no, not 7% of my overhead.
Right. 7% of the
7%. If I got my bid done and I said my cost is $100, I'm going to say it's 107.
Okay. So this is
And then divide that.
these are variable expenses is what you're arguing for. Some of them are, some of them are debatable, right? Some of them are.
One of them really is. The rest, yeah.
Okay. So what is there a distinguishment between variable expenses? Like, do you have a title for, okay, so what would you call this type of variable expense? Like,
well, I call it the same kind of variable expense, any cost of goods sold, but
right.
they are expenses that go up and down with sales. If you do not have a sale, you do not have that expense.
Right. But what I'm saying is, what would you call these types of variable expenses? Like, okay, we have all of these variable expenses. How are there different types of variable expenses?
I call them not really, not without confusing things.
Okay.
No, I call them missed expense. They could be divided up and allocated to the job.
But
I
it's
mean,
just
you
too
want
much
to know
of a
the
pain.
real correct, absolutely way to do it is you buy a bundle of 1,000 steaks and you put them in inventory and you carry them as an asset. And then when you go to a job, you take 50 of them and you take them out and you expense them to the job. That would be the fully appropriate properly AI does it for you.
Yeah.
Without, but we're just going, no, we're not going to do that.
Yeah, it's too much.
So we just figured it up and said those non-allocated expenses, in order to cover them, we probably need to have our jobs priced 7% higher.
Okay. And
Or
are
our
you basing
cost.
this off of just one job? Like, hey, we
we looked
one
at-
bid, or are you looking at, hey, we looked at 10 bids, it was an
Yeah, we
average of
looked at a
7%?
lot. I could tell you if I had my notebook, but we looked at, we looked at a lot.
Okay. Gotcha.
Yeah,
So maybe
so-
dozens. bids.
So all the hardcore stuff I talk about, variable costs and fixed costs, there's always a borderline where it gets fuzzy and blurry. And is it enough to make a difference? In this case, 7% of this is enough to make a huge difference. There was one other thing too that we found. And it was because we accounted for a bunch, but we couldn't find it all. The difference between what we were seeing between what he bid and what he actually showed up in the books. And it turned out that his office lady's salary was included in variable costs, like she was out laboring. That should not have been. It just was a code when they did their payroll allocation.
Okay.
She got allocated to overhead. So I don't remember I don't know what the percentage of that was, but that should have been enough to close everything up. And he can now explain why he was bidding 41 to 44%. He was coming in with 38. And then way back when, he was bidding 30 and he was coming in with 18. So we've generally raised his margins and we've accounted for why the margin on his bid sheet and on his tally sheet, I'm going to call it, when he got done, we fill in all what did that really cost you? Which, by the way, is a lot easier to do nowadays. It used to be pretty hard to allocate your labor to an actual job. Well, it's really easy with QuickBooks, and there are other. But, I mean, the labor on that job is the labor that went to that job. It doesn't include the time labor spent sweeping up the shop. That goes into their overhead payroll. But anyway, the advantage of finding out why it wasn't tallying was that we now understand, and if we want it to be our target of 40, then we have to add 7%.
So really it's a 47%.
So there you go. Yeah, 47% would be 40.
Gotcha.
No, it's not perfect math, but
Yeah.
but that is thinking why we do this stuff. Because you're going along, well, I'm bidding everything just fine, but you look at your books, I'm not making any money. Well, something's off. And the good thing about this client is he was obsessed. I mean, it's driving him crazy.
Yeah.
And so we said, well, let's figure it out. Took about an hour and a half, figured it out. Now he's got a decision to make. Maybe he doesn't want to go up 7 because he thinks it's going to price him out. Well, he's going to know. Maybe he can go up 3.5.
Right.
Whatever. But
And at
we
least
get
he
closer and
knows
closer.
what he's getting into.
Yeah,
nothing's
you're not
worse
doing
than-
it it's not an accident.
Nothing's worse than thinking you're going to get something and having that expectation and then coming in 7% lower is because 7, that's more than 7% if you do the math, right? Of like 40 and 33, the difference there it's greater than that. It's almost a 20% difference roughly between
40
33
and
and 40.
33?
What's that?
10. That's 7%. What do you
Well,
mean?
it's a 7% difference, but
Well, yeah, we got to watch our percents here. What we're talking about is you're going to take your cost. I said it wrong earlier, I think. If you got a $100 cost
Right.
from the stuff that you know about,
Yep.
you really have a $107 cost,
right.
right? So 107 divided by 0.6 would be a $178 price, and a 100 would be a 166. So the difference between 78 and 66, it raised the $22.
20%
Sorry,
is what I'm saying.
Yeah.
Right. So
Yeah, because you grossed it up.
exactly. So I mean, it's bigger than just 7 in the reality of things.
Oh, yeah. Yeah.
It's a bigger change, is what I'm saying.
It winds up being more than that, but the percentages stay the same.
Correct. Yeah. So it's just it's a big difference, and people need to like realize that. And I think when you think you're doing one thing, if you're not looking into it, and you continue to think that we had this conversation with foundation guy
Will?
in North Carolina.
Oh, Corey.
Corey.
Oh,
Corey had this exact problem where he thought something was, he's looking at his books and he thought it was this,
yeah.
and it was something completely different reason.
But it
there.
was a lot. Yeah, it
more
was
convoluted
double
reason
booking
there.
the sales. Yeah,
But same concept of like you're thinking that you're going down this path, and then you're actually going down a completely different path.
Yeah.
And it's like, what in the world is going on? It's good that he catches it with someone like you, but if he didn't recognize it, he may look up in 2 years and be thinking that he was, had 7% more profit.
Well, he made a lot of decisions based on what he's thinking the books were telling him, and they wound up costing him a lot of time and trouble and money.
Yeah.
Because they were wrong decisions. But that is the point, and I don't want to make it sound too hard. If you're bidding for 40% and you're not seeing that in your gross profit margin, you got to find out what the difference is.
Yeah.
That is management.
Yeah.
I mean,
And
that's what management is.
That's more valuable than you going out and chasing the next sale.
Yeah,
right?
well,
Because
absolutely.
the next sale is going to be 7% less than what you think it is.
Yeah.
Right.
Yeah.
And so if you can fix that one thing through management of working on your business, then you've basically gained 7% of every next sale in theory, right? Obviously you got to win the job and all that kind of stuff. But,
Well, and that's the other thing is people tend to dismiss, I can't go up 7%, which we're not going up 7%. We're going up by that anyway, where we did the math. But I can't go up because, I'm going to get my clients or my competition will kill me.
Right.
And say, well, you can't get water out of sand, right?
Yeah.
If you're going to go stay in business, you got to sell enough that you make a profit. And now you know why, so do it.
Yeah.
And I will acknowledge one of the hardest things in the world is doing business with a direct competitor who doesn't know his or her costs. I mean, it's insane.
Yeah.
And they eventually will go out of business. But unfortunately, there's a lot of times another idiot steps into the breach and says, well, that's a lot of money. I ought to be able to do it for that. They just don't realize everything that goes into it.
Quick ad break to tell you about Growth Kits. This is actually my company, and you may have seen it around, but I started Growth Kits because I kept seeing contractors struggle with the same problems over and over again. They were trying to be better organized inside of their business, but kept drowning in the day-to-day operations. So whether you need a better CRM, a hiring process that actually works, or you just want to make sense of the tech stack inside of your business, we have systems that are built specifically for contractors. You can either grab our DIY guides and implement these systems yourself, or you can hire us to work with you on it and implement it for you. No massive consulting fees, no year-long commitments or monthly retainers. Just pick what you need right now and let's get it done together. Head over to growth-kits.com to see how we can help you construct your success one system at a time. That's growth-kits.com, or just click the link in the show notes. Now, back to the show. I was actually talking to somebody just the other day that is kind of dealing with a similar thing of like some of their employees are seeing their numbers and like, man, like I only get paid this much. And like, I feel like I could go do this. Well, with this guy right now, he's actually paying 50% tariffs for his product. And I don't know how much his employees grasp that fact, but if they went on their own, they're not making 50% tariffs. So it's a very challenging thing that people don't get sometimes. So I want to kind of recap this just a little bit. So there isn't a distinguishment between variable expenses, but maybe we call some of these general variable expenses that are being applied to multiple jobs.
Yeah.
And they're getting
bulk,
missed.
We can call them bulk purchases if you
bulk
want.
Purchases,
like
right?
Yeah.
And if you're not keeping inventory and tracking that inventory, and maybe you really don't have that much inventory and it's too much of a headache to actually do the tracking of that to each job. For example, like the gas one is a really great observation that I didn't even think of. Like, how do you get that to every job? I think categorizing those as like a bulk purchase or a general variable expense and figuring out what that percentage is that you should be applying to each job can help you get your margins more accurate.
And it's really pretty common. Had a guy who works on trucks, big trucks. He had I think $25 screw and bolt charge that went on the bottom of every. Hey, I didn't care what he did. Put a radio in. You paid a $25 screw and bolt charge. And we were talking about that. There are lots of people understand this, but there are companies that sell bolts and nuts
Yeah.
and screws.
Yeah.
And they bring in a display and they keep it full. And that's a good thing because you don't want to be running all over the world looking for a 2-inch long number 8 wood screw, right?
Yeah.
And we would talk about, it's been long enough since the client I'm thinking of, but it'd be like $5,000 a month to keep that thing full. They just came in, filled it up, came in, filled it up. And if you don't charge, it's just a bolt. Well, I just grabbed a handful of bolts. If you don't charge for them, that's $5,000 a month.
Yeah.
Well, what are you going to do? Count, 700 different kinds of butts and lock washers and not lock washers and hex nuts that lock, and those that don't. And you're just not going to do it.
Right.
So, and I worked on a workover rig one summer. We had a project going on in the oil field. And anyway, it doesn't matter why he's doing it, but we get an invoice from these guys. And at the bottom of the invoice was $69 for a bucket of pipe dope. Okay. That you use when you,
I do not know
what I'm talking about.
Pipe dope. What is that?
Oh man. Well, anything that has pipe threads on it,
Yeah.
which doesn't mean any kind of threads. Pipe threads are tapered.
Okay.
Anyway, you either put Teflon tape or pipe dope on there.
Oh, okay. Teflon tape. Yes, I know what Teflon tape is.
Or pipe dope was a precursor to that, and they still use it. And its real purpose is to lubricate the threads so you don't gall. But anyway, $69 for a bucket of pipe dope for pulling the production tubing out of a well and putting it back. You had to dope the threads. Well, it takes very little pipe dope because I worked all summer on one rig and they used one. It was the same bucket of pipe dope, but it's $69 charge. That was a profit center.
Yeah.
Yeah. So that was an example, but so it's real common that you have to do something like that just for exactly that, bolts and water and Holland dirt and fuel. And so it's you need to know what that is because that can eat you up.
Yeah. So I want to get to the concept of burdening a little bit. I mentioned it earlier. We've talked about it in a couple of podcasts in passing. You're not a fan of it. I want to talk about why you're not a fan of it. Let's first explain what the concept is and why it might be a beneficial thing for someone to do. But then on the flip side, why you're actually not a fan of it. So what is burdening? It's a similar concept to what we're talking about, not the same, but similar in practice.
There are lots of ways people talk about burdening. One of them, for example, is I burden my payroll. In other words, you pay the guys $20 an hour, but you also pay them 10% worth of FICA food, SUDA, health benefits, and so you apply that and say, I'm really paying $30 an hour. They call that burdening, and I'm absolutely fine with it because it really is costs. And if it's variable cost labor, it goes up and down with whether or not the guys are working. So we have to make sure that nobody misunderstands what I'm talking about when I talk about burden. Second way burden is used is I'll see people bid stuff, bid a contract, and they'll put 15% margin on there, however they figure it. And then they add 10% and they call it burden. They just add 10% and they call it burden. And I'm fine with that too, because that's just a price increase. And I don't care if you call it M&M's, chocolate peanut. I don't care what you call it. You just added 10% to the price. Great. Where I get, and there are places that you have to do this. You have to do it for bonding companies, so do what you have to do. But what people will do is they'll take an overhead item, let's say it's workers' comp or liability insurance.
Okay.
And they say it costs us $100,000 this year. So I'm going to take, that job was $1 million. I'm going to take, get my proportions right. That job was $20,000. I'm going to take $5,000 of that $100,000 insurance bill,
Apply to
which
that
is
job.
sitting nicely down in overhead. I'm going to take 5,000 of it, and I'm going to put it on that job, and I'm going to reduce my overhead by 5,000. You've reallocated it from fixed to, well, the number one thing wrong with that, it's arbitrary. I just said 5%. Why not 10%? Okay? Let's say I do 10% is my standard. I'm going to go give every job 10%, and now I come up on my 11th job. Am I going to go negative? Am I going to leave it all? It's a meaningless, it's arbitrary and meaningless. People do it, and I'm for this, because they want to make sure that they get their true cost, that they have enough to pay for their overhead, enough margin to pay for their overhead. That's what break even is.
Mm-hmm.
Just take your overhead and divide it by the margin. That's how much you got to sell, right? So, and it messes with your margins. So on your very first job with these guys, you charge them 10% of your insurance as a burden, okay, on that bid. Okay, so that reduced your margin by 10%.
Okay.
Because you had your price, you take 10% more expense, it reduced your margin by 10%. It does do that.
Yeah.
Then the next time you do it with the same guy on the same thing, but you've already burdened him once, so you don't burden him again, your margins are off.
Okay, I see.
And there's always,
So it's
even if it's
inconsistent.
not the same guy, there's always a point where you've used the whole 100,000 and your margins change,
Yeah.
right? I'm allocating. Oh, now I've used all the, my margin just went up by 10%. Well, you can't do any of the planning that we talk about using break even if your margins change right in the middle. I mean, if they change because expenses change or prices change, but not just arbitrarily changed. What's your planning number?
Gotcha.
Right.
So I think the one that I think of with people that I see commonly is the one that you said you're okay with because it's just a price increase. So, hey, in general, we just add 10% for overhead burden to every bid.
Yeah.
And you're
Yeah,
okay
and
with that
that-
because it's essentially just a price increase.
Oh, yeah. Yeah.
But you have also said in the past, well, if it causes you to lose the job, what if 9% would have gotten you the job instead of losing it at 10? And you've said, would you take the job
burdening?
at 9%? Yeah, yeah.
Yeah. Oh, yeah.
So that's the one that you've told me before is like, you just had a profitable job that you turned down.
Oh, I see. You're talking about it gives them
Yes.
misleading information that they're acting on, not what I said. Yeah, absolutely. If you stick a big old, well, I have I mentioned a company in my book from West Texas, manufacturing company, and when I went in there, I thought it'd be pretty cool because they didn't understand break even or anything. They'd just been doing the same thing over and over.
Right.
And real slim margins, real tough business that they were in. And one of the things I asked him was, what does your labor cost you? And the guy told me, I can't remember, 68 or 88, whatever.
Sure.
Some huge number. And I go, well, how's that? And I make the point that I've been in the parking lot of this place many times, and they said their labor rate was $80 an hour, which is equivalent to $160,000, right? That's a full-time at $80 an hour is $160,000, 2,000 hours. And I said, well, I've been through your parking lot. I don't think that anybody out there is making $160,000. Somebody would own a Ferrari, right?
Yeah.
And I said, where did you get it? They ticked off really, he didn't have an answer. He said, well, it's what you pay the guys, and then they get the common things about I've got to pay their taxes and their benefits.
Right.
But
Insurance.
then we've got to have something to make a profit. So they added something to make a profit. And I said, let's say the total of the actual cost was $30. They're at 80. I said, well, you added $50. Where'd you get that? Well, we got to make a profit. I go, I know. But you're making $50 an hour profit if you get that job, but you're going to pass up a $70 an hour job because you think you're going to lose $10 an hour. Well, you're not. You're going to make 40 as a margin, right?
Yeah.
So it leads to all kinds of, And nobody can tell you where it came from. So if you want to improve it, which is the goal of management, right? What are we going to work on? I mean, obviously fewer labor hours, but other than that, what can we do?
Yeah.
So you're just, burden. People get defensive. I've had a couple of people get really angry at me for talking about it, so I kind of back off a little bit. But
I think at the end of the day, like, you both have the same goal, which is to run a healthy business, right? And you want to do it by means of really calculating and being very specific with the numbers and knowing the numbers very accurately. And they want to do it by making sure that they cover all the costs are covered, so in some capacity. And you want to do that too. They just don't want to have to go through the calculations.
Here's my whole burdening is something you do for bonding companies, because bonding companies want to know how far along are you,
Sure.
and how much profit have you made. So it's a thing that, and GAAP accounting uses it, and it's a thing that they try to take all, which is fine. There's not a single operating decision to be made in burdening, right? There is in WIP, which is another subject, which is what bonding companies use it for. But how else are you going to know what I have to sell to break even? And how else will you know the fact that I talk about a long time, that if you can raise your margin 1%, which is from like 30% to 31%, that you'll increase your net profit by 15% if you're an average company in the U.S. How can you know that? The burdening messes everything up, because you don't have, if you had $1 million in the overhead pot that you're trying to break even and you're taking chunks of it out, where did it go? And I don't know how you can calculate anything. I don't know. It drives me crazy. And it could be that I'm wrong, but I'm not. And I cite my authority as Spencer Tucker, who wrote the break-even system in the 60s, who is the father, really, of break-even. And he's famous. People use his charts and all this. They don't even know where they came from. And he says it. He says burdening is an arbitrary exercise. Just do not do it. Screws up good information. Say it.
Okay.
Remember, take that 10% from overhead and put it on there. Why not 5? Well, I don't know. And then guys are arguing. Or you got a plant in another town and you charge them more overhead than you. Well, we didn't. Well, you talked to Wanda. She did your invoicing. She's part of what you do. No, that's all.
Yeah. Okay. Well, I've seen you get in the heated discussions before.
Yeah, I know. So I need to shut up.
No,
I get into heated discussions because it's confusing. It's even confusing to me, the arguments against it, other than that arbitrary argument. But if you allocate your overhead out to jobs, you change the margins, you reduce the job is priced, you allocate on it, you reduce the price. Okay? Or you raise the price to cover the overhead. That's fine too. When that overhead runs out, now your margin changes, but you didn't do anything differently.
Yeah.
So I stick with Spencer Tucker. If he didn't say it, I wouldn't be so strident about it.
Yeah. Well, I think people will definitely, this topic will resonate with them because they deal with this. But I think that the biggest thing is that, what they can go and do right now is what you did with your client, is go and review the bids and see where the numbers were wrong and what you were actually coming in at, and then diagnosing the issue of like, oh, we have these general variable expenses that are out there, like gas in the vehicles and the bundles of steaks we buy, but we don't inventory them, and all these kinds of things, and start to figure out, okay, what percentage of each job are we losing to these expenses that we're not allocating to jobs. And once you calculate that percentage, then you can, add those or a portion of those to your costs and in your bid.
Yeah.
So, well, thanks for sharing, Martin. Hopefully this is helpful to people, and we'll see you on the next one.
Okay, man.
You made it to the end of the episode, but before you go, if you found yourself thinking about growing your construction business while listening today, I want to share something with you. It's called our 24 Things to Hiring and Training the Perfect Executive Assistant for Your Construction Business. And It's a free guide that we've created. It's not theory. It's what we actually use to help contractors hire the perfect executive assistant. And really, we help you find ways to delegate over 50% of your current workload and get back 20 hours of your time every single week. You didn't start your construction business to just be doing admin work, to be buried in paperwork and endless admin tasks. This is the guide that shows you exactly how to find and train someone who can actually take all that weight off of your shoulders. So this is a real actionable, great PDF that has templates and processes. It's really, really great. And I want you to check it out, even just to get your feedback and how we can make it even more valuable. But I know that you're gonna love it. The link is in the show notes. Please download it. We'd love to see how much of an impact it makes on you and your business. Thanks for listening to the full episode. Check out the guide. It's free. No reason to hesitate. No reason to wait. Download it now. And before you go, I just want to ask for your gracious subscription to our podcast. So if you have 2 seconds, it means the world to us. Just subscribe on YouTube, Spotify, Apple, or if you'd like our weekly newsletter delivered to your inbox whenever we release an episode, please subscribe in the show notes. Every week, we're talking about real strategies on how you can grow and build a profitable construction business that runs without you, so you can have less stress, more time, and more money. Click subscribe wherever you listen to the show, and thank you again for checking out the Cashflow Contractor. See you on the next episode.